Hello, everyone. This is taking a look at tax. I am a tax preparer. I do have a business where I prepare taxes for people, so this class is help you understand personal tax. It'll get into some of small business Schedule F taxes as well. So this is part one, conceptual foundations of the tax law. Federal income tax. This is an overview, and this is concepts in federal taxation. So these are learning objectives. Explain what constitutes a tax and the various types of tax rate structures that may be used to calculate a tax. Explain the major types of taxes in the United States. Identify the primary sources of federal income tax law. Define taxable income and other commonly used tax terms, and then explain the IRS audit process and taxpayer rights within the process. And lastly, explain the calculation of taxable income for individual taxpayers and the unique personal deductions allowed to individuals. So this is just an explanation. By the end of this section, these are the objectives, meaning you should have an understanding of these. Develop a framework for tax planning and discuss the effect of marginal tax rates and the time value of money on tax planning. You'll be able to make the distinction between tax avoidance and tax evasion. Explain ethical considerations related to tax practice. So, definition of a tax. An enforced involuntary contribution required and determined by law. Provides revenue for public and governmental purposes. Special benefits, privileges, or privileges are not received as a result of making the payment. So purpose of a tax, revenue, social changes, economic changes, and then equity as well. So standards of good tax system, Adam Smith's 4 criteria. Equality, certainty, convenience, and economy. Okay, so these are things we're going to take a look at. So equality, tax should be based on the taxpayer's ability to pay. Horizontal equity, 2 similar situated taxpayers are taxed the same. Okay, and vertical equity, differently to situated taxpayers are taxed differently but fairly. Okay, so we're going to take a look at what that's going to look like. Certainty, when and how a tax is to be paid should be known to the taxpayer. The taxpayer should be able to determine the amount of tax to be paid. Convenience, tax should be levied when the taxpayer has funds available to pay. Pay as you go concept, taxes are paid as close to the time the income is earned as is reasonable. Okay, as is reasonable is key. Okay. Economy, the cost of complying with the tax system should be minimal. So tax rates for income tax. So the marginal tax rate, the rate of tax on the next dollar of taxable income or the rate of tax saved by the next dollar of deduction. Average tax rate, the federal income tax divided by taxable income. Effective tax rate is the total federal income tax divided by the taxpayer's economic income. Economic income includes all the taxpayer's income, whether it is subject to tax or not. Okay. So here's graphically what this will look like. Proportional average tax rate remains the same as the tax base increases. So on the left side, as you can see that tax rate and then tax base. On your horizontal axis, you have tax base. On your vertical axis, you have tax rate, and that's similar in both graphs. And of course, the marginal rate equal the average rate, and then of course your slope is going to be your total tax paid. Tax regressive, so average tax rate decreases as the tax base increases. So if, again, your tax base is on your horizontal axis and your tax rate on the vertical, as you can tell, it decreases. Regressive means to go back down towards zero. So as you can tell, the tax rate is decreasing from left to right. Okay, so it's a downward slope. And of course, look at your marginal tax rate on the right. Is the slope is steeper than the average tax rate. Okay, so that's kind of what that's saying is, as more people, as the tax base increase and is larger, then it decreases. Okay, and that's why we're saying it. That's what it's saying is the amount of taxes that is paid should decrease. Progressive, average tax rate increases as the tax base increases. Okay, again, the left tax base, and then your tax rate is lower than your tax base. Over on the right, you have your total tax paid, then you have your marginal tax rate, and then you have your average tax rate. And notice that's increasing from right to left. Progressive. Okay. Majority types of U.S. taxes. There's the income tax, employment tax, sales tax, property tax, excise tax, wealth transfer tax, and then healthcare related taxes. So these are all taxes that we look at in the U.S. Income taxes, they are taxes paid by individuals, corporations, estates, and trusts. The income tax is levied on taxable income. Taxable income is the difference between the total income of a taxpayer and the deductions allowed. Okay, so your income, your taxable income, or your income minus your deductions, and that'll be your taxable income. It's determined on an annual basis. Your employment tax are paid by employees, employers, and self-employed taxpayers. Tax base is the salaries and wages earned. Two major types are Social Security taxes and unemployment taxes. Okay, employment taxes. Sales taxes are paid by the purchaser of goods and services. Tax base is the selling price of a product or a service. Property taxes are paid by owners of property. Real property is land and any structure that are permanently attached to it, such as buildings, okay, barns, things like that. All other types of property are personal property. Tax base is the assessed value of real or personal property. Ad valorem taxes, okay. Excise tax are paid by purchasers. Tax based on the quantity purchased and not the value of the purchase. So looking at quantity versus quantity and not value. Wealth transfer tax. Gift taxes are paid by the donor of property. Tax base where the gift tax is the fair market value of the property transferred. That fair market value, that's very common in accounting and business. That's the value that it can be sold today. Transfers to spouses and charities are excluded. Donors may exclude annual gifts of $15,000 per donee. So if your parents were to give you money, or someone gave you money, it'd be 15,000 or less. Okay. Married couple can use this exclusion to make tax-free gifts of up to 30,000 per person per year. Okay. Estate taxes are paid by the administrator, called the executor of a deceased taxpayer's estate. Tax base for the estate tax is the fair market value of the assets a taxpayer owned at death. Unified credit excludes up to 11.7 million in property from gift and or estate tax. Careful planning is required to minimize the lifetime tax on gifts and property held at death. Executor of the estate must file an income tax return that reports the income and the deductions related to the assets of the decedent. Healthcare related taxes imposed on higher income workers. So 0.9% hospital insurance is applied to wages in excess of threshold amounts, net self-employment income in excess of threshold amounts. And we'll get into this as we proceed through this course. Surtax on unearned income, 3.8% medical contribution tax on unearned income of individuals, estates, and trusts. For individuals, the taxes imposed on the lesser of net investments income or modified adjusted gross income. AGI is adjusted gross income in excess of the threshold amount. And we'll get into this, but adjusted gross income is any adjustments that you have that I believe are pre-tax. That'll be your adjusted gross income. So it's usually your front page of your 1040. Sources of federal income tax law. So there's legislative law, meaning the Internal Revenue Code, or IRS. There's administrative, the Treasury regulations, IRS revenue rulings, revenue procedures, and other pronouncements. And then there's a judicial, U.S. Court of Appeals, or U.S. Circuit Court of Appeals, Supreme Court, and then other courts as well. If it goes through those different stages, that's the process, I guess, to litigate or mediate any tax issues. So income tax computational framework. So income broadly defined. So minus excluding income, which equals your gross income. Okay, your net income is what's going to be left. Okay, we'll go through that as well. So your gross income minus your deductions equals your taxable income. And then at that point, you're going to look at the schedule of rates to get your tax rate. Okay, and that's going to equal your income tax. Then you're going to minus your credits. Okay, your tax credits, any payments, prepayments that you might have made, meaning your tax repayments, any payments equals your tax refund due with return. Okay, so then if there's a difference there, then that's what you're going to receive back. Or if you overpaid, then that's what you're going to receive back. So some income definitions: gross income, income broadly defined minus income items that are excluded from taxation, exclusions, increases in a taxpayer's wealth and recoveries of the taxpayer's capital investments that Congress has decided not to be subject to income tax. Okay. Deferral and exclusion that does not have a current tax effect. And then a deferral will be subject to tax at some point in the future. Okay, so those are deferrals, exclusions, and of course, your gross income. Some income definition: ordinary income, recurring income earned by a taxpayer for a tax year. That's going to be most people. If you have a job and you're having recurring income. Gain is the difference between selling price of an asset and its tax costs, and is the result of disposing of the asset. So if you have any capital gains, that's what that's referring to. Expenses, these are some deductions. Expenses, current period expenditures incurred in order to earn income. Okay, for example, like business expenses or expenses that help you for your job, things like that, although it's been limited. Losses, transaction losses result when an asset is disposed of at a price less than the tax costs. Okay, I'm saying if you sold an asset, let's say you sold your house, it's worth $200,000 and you only could sell it for $150,000, so that's be a $50,000 loss. Annual losses results when allowed deductions exceed income. That's just an example of what I just showed you as far as the loss. We usually refer to as capital gains or capital losses sometimes. So tax formula: tax due, taxable income times your tax rate equals income tax liability. That liability is what you're liable to pay. And this, by the way, is the bottom half of our tax formula we saw above. Minus prepayments and credits, that equals your tax due or refund due. So depending if you had enough taxes, prepayments. Usually, someone always told me you can only get back what you put in for the most part, unless you're below a certain threshold of income for a year, usually around 24 to 26,000 per year, then typically you get certain deductions. Or like child tax credits, things like that. Income tax rate is calculated by multiplying taxable income by the applicable tax rates. This is usually where you go into your codes, or not your codes, into your rates, tax rates. Each year, the IRS publishes new tax rate schedules that are adjusted for cost of living increases. So your cost of living is a part of it. So that kind of helps with a little bit with inflation, but not necessarily, because your income doesn't go up with inflation as well. Sometimes it does, but typically it doesn't. Tax prepayments. Tax prepayments are subtracted from the income tax liability, determine whether the taxpayer has underpaid or owes additional tax with the return tax due, or is entitled to a refund of overpaid taxes refund due. Keep in mind though, like if you have a large refund, that means typically you didn't make the proper adjustments to your deductions or withholdings. Okay. Tax credits. Direct reduction in the income tax liability. Credit is not deducted to arrive at taxable income, but is instead subtracted directly from the income tax liability. So your filing requirements: return must be filed annually. That's why once January into January, a lot of times your businesses and employers start sending out your tax documents, and usually have to be filed by April 15th or around the 15th, depending. If April 15th, so Friday, Saturday, or Sunday, they bump it to the following Monday. Okay. Calendar year individuals file and pay on or before the 15th of day of April may receive an extension of time to file, but this does not extend the time for paying the tax. So even though you get an extension and you file, well, even though you file an extension and you have tax that's owed, there's still interest charged. Calendar year partnership and S corporations file and pay on or before the 15th day of March. Statute of limitations, 3 years from the file date. Extends to 6 years if income is underreported by 25% of gross income. Okay. No limitation for fraud or if no return is filed. Okay. A lot of times I file taxes like for 4 or 5 years back for people, because a lot of times they owe. Actually, the IRS knows if you owe. So they typically will send you a tax bill if they know you owe. Okay. Audits and appeals process. Selection for audit. Only about 2% of returns are audited. So the procedures used: discriminant function system, or DIF, taxpayer compliance measurement program, or TCMP, document perfection program, information matching program, and then special audit programs. So these are some procedures that is used to identify if your tax returns qualify for audit. And of course, you can look up the 10 most warning signs or 10 red flags on Google, and you can find what some of those red flags are. So audits and appeals types of examinations: correspondence examinations, office examination, field examinations, settlement procedure, report of the outcome of the audit, waiver of assessment is Form 870, and then 30-day letter. Okay, they'll never contact you by phone. Okay, never. Okay, it's always with a letter. So the appeals, meeting with IRS appeals division, protest letter, and then a 90-day letter. So this is kind of what will happen. So individual income tax calculation: all sources of income broadly defined minus exclusions from income equals gross income, minus your deductions for adjusted gross income, trade or business expenses, rental or royalty expenses, other specifically allowable deduction. That's what equals your adjusted gross income. Minus deductions from adjusted gross income, personal deductions, the greater of itemized deductions, allowable personal expenses, and certain other allowable deductions or individual standard deduction. Okay, typically it's the standard deduction. Back when the tax changed about 4 or 5 years ago, the standard deduction is usually larger than you being able to itemize. So that equals your taxable income. So deductions for adjusted gross income, trade or business expenses, rent or royalty expenses, capital loss deductions, contributions to individual retirement account, IRAs, reimburse employee business expenses, half of self-employment taxes paid, self-employed medical insurance premiums, and then up to $2,500 of interest on qualified student loans. Okay, so those are your deductions for AGI. Deductions from adjusted gross income. Individuals are allowed to deduct certain personal expenditures and other specified non-personal expenditures as deductions from adjusted gross income. This is referred to as itemized deductions. Standard deduction is an amount that Congress allows all taxpayers to deduct regardless of their actual qualifying itemized deduction expenditures. Okay, typically, like I said, most of the returns I file out of, let's say, out of 100, I think only one person has enough documentation for itemized deductions. Itemized deductions reduce taxable income only when a taxpayer's total itemized deduction exceeds the allowable standard deduction. Okay, and sometimes I have people that it's like, oh, I had $12,000 or $15,000 in gifts to charity or charitable contributions, and I'm like, now, typically though, the IRS has a chart indicating how much a person that makes $50,000 a year can donate to charity. So you might want to take a look at that. I usually tell people that. So tax planning goal is to maximize after-tax wealth, considers the time value of money, defers income, accelerates deductions. It considers marginalized tax rates, recognizes income in the year of the lower marginal rate, recognizes deductions in the year of the higher marginal rate, and then shifts income to the taxpayer with the lower marginal rate. Income shifting splits a single stream of income among two or more taxpayers. Tax provisions to block blatant shifting schemes lacking economic substance. So these are things to look at. Okay. Usually financial planners help you with this, or accountants can help you with some of this as well. Okay, so there's definitely places you can put money. Like it says, you can defer income, and it takes a lot into consideration. Tax avoidance versus tax evasion. Tax avoidance, use of legal methods allowed by the law to minimize a tax liability, involves planning an intended transaction to obtain a specific tax treatment. Tax evasion occurs when taxpayers use fraudulent or deceptive behavior to hide actual tax liability. There's three elements involved in this: willfulness on the part of the taxpayer, an underpayment of tax, and an affirmative act by the taxpayer to evade the tax. So those are the three elements. So there's a lot of ethics involved in tax. Preparers are subject to penalties for negligence and fraud. So ethical standards, IRS Circular 230, AICPA's Code of Professional Conduct, AICPA standards, or statements of standards for tax services. Okay, these are all ethical considerations to take a look at. Okay, so that's the first part of this. Again, if you have questions, feel free to reach out to me via email. Again, this is a topic that you all will deal with at some point in your life, because whenever you're in the United States, this is what we deal with yearly. I know I've heard people say the only thing that is constant is death and taxes. You probably have heard that saying, but this is what we're kind of getting into this, and we'll get into a little bit more depth of a lot of this information and tax and understanding of tax. Okay, again, let me know if you have any questions.